Hare Krishna. Once again, welcome to my channel, Purposeful Prosperity. We are continuing with our wisdom series from the Little Book of Common Sense Investing, and today we are going to explore the chapter number 13, titled Profit from the Majesty of Simplicity and Parsimony, where it says that the whole traditional low cost index fund and track the stock market, that's the simplest way to earn your fair share of stock market. So there is a very famous quote where he says that in character, in manner, in style, and in all things, the supreme excellence is simplicity. So simplicity is the one that is normally getting ignored in all the different branches of knowledge. But it's the simplicity only which is having the supreme excellence. So same thing applies even in investment also. So your investment also journey, especially if you are a passive investor, it should be as simple as possible. If you are not making your passive investment simple, then you are no longer a passive investor. You are an active investor. Similarly, there is another famous quote which says that with parsimony, a little is sufficient. Without it, nothing is sufficient. But frugality makes a poor man rich. So we understand that if a person is really satisfied with whatever he has, it is good for him, he can be happy. And if a person is dissatisfied, then however or how much he is going to get, he is never going to get satisfied. So parsimony is again an important key. And Bogle is trying to combine both this simplicity and parsimony in this chapter. Let's just understand how. So before we begin in this chapter, so we start with the what all we have learned till now in the previous chapters. So we understand that the cost really matters in the investing, and these are the learnings from chapter 5, 6, and 7. We also understand that selecting the equity funds based on their long-term past performance doesn't work. Even the short-term performance also doesn't work. That's the chapter 10 learning. We also understand the important principles of reversion to mean, which is quite evident, uh, especially in the mutual fund industry. Those were the learning from chapter 11. And we also mentioned that relying even on the best intention advice work only sporadically. So even if you find the best uh, registered investment advisor for you, but if you are going to ask him which fund is going to beat the market, then unfortunately he is not going to help you. So those were the learning in the previous chapter, which is chapter 12. So let's just understand what chapter 13 has to say to us. So chapter 13 begins, Bogle is beginning with a Monte Carlo simulation. The Monte Carlo simulation normally says that when it is trying to predict something, if you have multiple factors of variability. And I think the same thing applies even in investing also. So in this graph, if you look at the right hand side, uh, where they assume that the index fund is going to take a cost of 0.25% and an active fund is going to have between 1 to 2%. So if you look at this data, so we can see that in a 1 year time period, 29% of funds are going to beat the index. If you take it for a 5 year, then we say 15% of active funds are going to outperform the market. In 10 years, if you go, it's only 9%. 25 years, it's 5%. If you go to 50 years, it's only the 2% of the funds which are going to outperform. So this Monte Carlo simulation clearly says, and the arithmetic also suggesting the same thing. Even they demands that the index fund deserve an important place in our portfolios. If we are not putting good enough percentage for our index investing in our core portfolio, then definitely we are going against the mathematics. And that's the humble rule of arithmetic. We should be going with the arithmetic instead of trying to do any sort of a gambling here. So in a long term, we clearly understand that it's very difficult for an active outperformer to beat the market because of the cost involved. So Bogle further in this chapter reiterate where it says that all these pesky cost of fund expense ratios, sales charges, turnover cost, tax cost, And the most subtle cost of all, the rising cost of living, which is inflation, are virtually guaranteed to erode the real spending power of our investment over a long time. So that really, we really had to understand that all these costs does exist. And if you, even if you are not investing, inflation is still going to erode the power of your money that you are going to have. So we have to invest. And in case of investing, then these are the additional costs which are going to come, and we need to make sure that how we can minimize this thing. Further, Bogle says that what's more, only in the rarest case do fund investors actually succeed in capturing the return that the fund report. And even after paying all these costs, the uh, the real issue is that the fund investors are not going to capture whatever the returns which are actually reported by the funds. Why? Because of the investor behavior that we understand in the previous chapter. So Bogle is trying to give a conclusion where he says that my conclusion about the share of these returns that fund will capture and the share of those return that we investor will actually enjoy have one thing in common. And what's that? And it's not my, and as per Bogle, it's not his opinion, but it's a mathematical fact. The relentless rule of humble arithmetic that makes selecting winning fund akin to looking to a needle in the haystack and ignoring those rules at your own peril. So he clearly says that it is not Bogle's opinion. We really have to understand. We are talking about the mathematical facts. We have to understand the different costs all these mutual funds are going to have. And with all those costs in a long term, they can never beat the market. And if we still want to ignore this arithmetic rule, then I would say we are we are seriously injuring our journey in the investment. And we should not be doing it if you are a really intelligent investor. So your a big chunk of your portfolio should be with the investing. So let's just understand about the road of investment. So Bogle says that if the road were investment, success is filled with dangerous turns and the giant pothole. Never forget that simple arithmetic can enable you to moderate these turns and avoid these potholes. So if you are simply going with the mathematics, then there are very less chances of you getting failures in your investment journey. And for that, Bogle says that do your best to diversify it to the nth degree, minimize your investment expenses, and focus your emotions where they cannot wreak the kind of havoc that most other investor experiences, and rely on your own common sense. So we say that there are five senses, and the sixth one is common sense, but the common sense is the most rarest one. So we should always be having our common sense intelligent. We should be having a strong common sense, and that can only come when we read about these great investors like this and try to extract the wisdom from them. So we really need to diversify, and we understand that if we are investing in a, let's say, Nifty 50 or Nifty 500, we have really diversified. We are only having the market risk and not the stock specific risks or the sector specific risks. So we are definitely diversified. At the same time, we really need to hold on to that thing. It's not a trading thing and that buy and sell and then you buy again and you again sell. That's not the recommended. So use the common sense. You buy a low cost index fund and hold it forever. It doesn't matter how whether the markets are going up and down. So that way you can really control your behavior. And the last point where it says that carefully considering your risk tolerance and the portion of your investment you allot to equity and then stay the course. So this is really important. We really have to understand that what is our risk tolerance, how much of loss we can see on our index investing or even of our stock investing if case you are an active investor. So this risk tolerance, every one of us is different. None of us are unique. Every one of have different level of risk tolerance, and we really need to evaluate ourselves. For that we have to first of all understand what are our risk tolerance level, and based on that we should be allocating only that much percentage of our total portfolio into equities that is as per our risk tolerance level, and then keep on with that investment percentage with you. Then Bogle further continues where it says that Although we understand that we should be investing in an index fund, but then not all index funds are equal. Why? Because even though they seems seemingly same because they are tracking the same set of companies, but there is a difference in the cost. And the cost will be in terms of their expense ratio, and some of them even have the sales load. And that's what we can see on the left hand side, the data that we've been seen. So where Vanguard is starting with 0.04%, and we have seen that it has gone and high up to of 0.66%. At the same time, the higher cost fund not only having the higher expense ratios, they are also charging the sales load. And if you look at the JP Morgan equity fund, it's having a 4% of sales load. So that's really a huge cost. Although the sales load is getting spread like between 5 or 10 years. So, but then also it's a cost actually, and we want to avoid that. So the wise investor will select only those funds that are available without the sales load and those operating with the lowest cost. So that's the advice he is giving to a wise investor. And these costs, no surprise here, directly relate to the net return delivered to the shareholder of these funds. So wherever possible, try to save on the cost, because all this saving on the cost, that parsimony that we are going to follow, we are going to get huge benefit in our investment journey. So Bogle clearly says that the index funds are not created equal. So the intelligent investor will select the lowest cost index fund that are available from reputed fund organization. That's also very important. So there are two terms. We have to select the lowest cost index fund, but at the same time we need to make sure that they are available from a reputable fund organization. We cannot invest in any index fund which has been uh, launched by an organization which is very new to the market or to the industry. So please try to avoid those mistakes. So if we take care of those two things, then we should be fine in our investment journey. So Bogle here introduced one more term which is called the cash cow. So as per Bogle, we should be really careful in selecting the lowest cost index funds for our portfolio. And you can be sure that the fund is not the manager's cash cow, but your own. So there are many funds, or in fact AUM companies, which are simply launching those index funds, but they are using them as their cash cow just to fetch the money. So we really need to make sure that they actually follow the index investing and don't use their fund as a cash cow just to earn some additional cash for their organization. But this cash cow should be for the investor and not for the AUM company. So Bogle further continues and says that the what whether markets are efficient or not, indexing always works. So here, uh, I think Bogle is giving there are two arguments which says that the indexing only work in an efficient market, and there is one more argument which says that indexing only works in a developed market. It doesn't work in emerging equity markets, and that's one of the reason people in India believe that indexing is not right now the best choice available. But Bogle clearly says that whether your markets are efficient or not, indexing always works. And he also trying to give some examples for that. So first of all, he's beginning with, so whether markets are efficient or inefficient, all investor as a group in that segment earn the return of that segment. So if a one manager is getting a higher return or a higher alpha, there is another manager who is going to lose. So as a group, they cannot earn more than what the market earns. And in efficient market, the most successful manager may achieve unusually higher return, but that means some other managers suffered unusually large losses. That is something we don't care about. We always see, okay, this is my fund manager, he can earn these extra alpha for the fund that I am having. But we really need to understand that there is some other manager also who is also qualified. He is going to have some losses also for that. So overall, the fund industry return cannot be more than your industry return. Bogle further says that never forget that as a group, all investor in any discrete segment of a stock market must be and are average. So he is bringing all the investor, be it a retail investor, FDI, or a foreign portfolio investor, or DII, all of them are same or the average. So there is 1% benefit, there is another person loss. Combine them, all of them together, they cannot earn more than the market return. And same thing applies even for the international funds, where because they also trail their benchmark indexes. Where Bogle gives two example, he says that S&P reports that the international index fund outpaces the 89% of actively managed international equity funds for the last 15 years. See, 89%. You are in part of that 89% success if you would have invested with the international index fund. Similarly, for the S&P emerging market index fund outpaces the 90% of the emerging market funds. So once again, clear winner, we can see that indexing is always working, be it a, a developed market, a emerging market, efficient market, or a non-efficient market, international market. In every scenario, it is working. We have got enough data to confirm on this thing. So Bogle is concluding this later in the chapter where he says that with indexing so successful in both more efficient and less efficient market like in US market or in global markets. So he's saying that I'm not sure what additional data would be required to close the case in favor of index fund of all types. So index funds are working on all types. You cannot say that index funds are only good for large cap. He in the couple of his chapters which we are going to see in the coming sessions, he clearly explained that these even works for a small case and a mid cap companies also. So indexing always works in all cases. Then Bogle further introduced one more term which is known as sector investing. There are a few investors who invest in indexing, but they also take advantage of sector investing, where they assume that a particular sector is going to beat the market. So Bogle clearly says that the sector investing is also a kind of gambling. So in sector investing, Bogle clearly says that this is a gambling. So while investing in a particular market sector is done because most efficient through index fund. So we clearly understand that if you are doing a sector investment, then also the index fund are preferred compared to investing in individual stocks. But betting on winning sector, then another is exactly like betting, and betting is a loser's game. There is no way you can get the market beating return over a long term by sector investing. This can sector investing can be a part of your satellite portfolio, but not your core portfolio. And sector investing should also be done through the index fund. Why? Because largely because emotions are almost certain to have powerful negative impact on the returns that investors achieve. Because we clearly see that as soon as the particular sector started performing good, or we see some very good returns from past 1 year, everybody will start pouring money into them. And then that sector is going to become the worst performing sector. And we are not going to get return. That's the default investor behavior. And it is that behavior only because of which this sector investing also becomes like a gambling. And there is abundant evidence that most popular sector funds of the day are those that have repeatedly enjoyed the most spectacular decent performance. So we clearly see that even all these mutual funds which are getting created by these AUM and fund industries, they also create those funds only when a particular sector is hot and when everybody is trying to put money into them. And if you are investing in those newly launched funds which were created just because of their past performance, then we are really creating a big hole in our investment success journey. So the strategy of trading based on after the fact popularity is a recipe of unsuccessful investing. See, it's a very good line. So we retail investors are always acting after a news have come up. And we really need to understand that such kind of a news that we are listening, it's already an old news. Everybody has got the news, then only last is the news is going to come to the retail investor. And if you are going to trade based on that information or after the fact popularity, then it's a recipe of unsuccessful investing. So we should be definitely avoiding. So if you want to play the sector investing, Then play it through index fund, but it should not be part of your satellite portfolio, a small percentage of your core portfolio, and it should not be your major part because this is a sort of a gambling. Then Bogle further says that you should be always avoiding the complexities and relying on simplicity and parsimony. Where Bogle says that when trying to pick which market sector to bet on, look before you leap. So we should always look before we selecting any sector. It may be as exciting as gambling, but owning the traditional stock market index fund at rock bottom cost is the ultimate strategy. It holds the mathematical certainty that marks it as a gold standard in investing. So if you really want to follow the gold standard of investing, then you should be always investing in a low cost index fund and ignore all other things. This is the simplest thing that you can do in your investment journey. And that's going to create wonders for us. Try as they might, the alchemist of active management cannot turn their own lead, copper, or iron into gold because of their additional cost. They cannot beat the market. I think till now we have sufficient data for us to conclude that none of the active funds are going to beat the market in the long run. It's like finding a needle in the haystack, and that's a very large haystack. Why to put in efforts like this? Why to take a gambling in your investment journey? Let's make it pretty simple that we are going to do an index investing. That's all. Your life is simplified. Bogle says that avoid complexity and rely on simplicity and parsimony, and your investment should flourish. I would say I think this is the line we should be taking from this chapter. I would again read it for all of you. Avoid complexity and rely on simplicity and parsimony, and your investment should flourish. That's all you need. At the end of the chapter, Bogle is trying to give a quote from Mr. Uh, Michael. He's having a very highly published book, More Than You Know, uh, where he clearly calculates the odds of a fund outperforming for a 15-year consequently is 1 in 2 lakh 23,000. Can you see the percentage? Even for a 15-year. And then he's saying 1 in 31 million over 21 years. So he is even performing worse data than what Bogle has presented. So either way, the odds of outpacing an all market index fund are well terrible. Do you really want to play those terrible picks from the market? Then actually you are gambling on those active funds which are available. You have 100 funds and you assume that two of them are going to beat the market, but this is not based on some data. You are simply making a guess game or a gambling. And can sometimes create terrible results for your investment journey if you become a wrong in selecting your funds. So why to make your investment journey complex? Why not stick to a low cost index fund and just let it flourish? Then another quote is given by Mr. Charlie Munger where he says that there is one thing sure about all the complexity. The total cost of all the investment manager plus the frictional cost of fairly often getting in and out of many large investment positions can easily reach 3% of foundation net worth per annum. We really have to understand that when these large mutual funds who are having very large AUM, when they try to exit from one stock and try to enter into another stock, then with such large money, if they try to make this kind of a jumps more frequently, then it can cause up to 3% of the net AUM. That's a lot of loss per annum. And we clearly see in the last chapter where Warren Buffett says that your a fat wallet is the enemy of your return. So same applies for these big AUM industries also, which are doing this more frequent turnovers. So Charlie Munger further says that all the equity investors in total will surely bear a performance disadvantage per annum equal to the total corporate cost they have jointly elected to bear. So if you have selected a invest active mutual fund, then you jointly agree to bear that cost which all these AUMs are going to have, and all the costs that we already understand in our previous chapters. Charlie Munger further continues and says that it is unescapable that exactly half of the investor will get a result below the median result after the corporate takes a median result that will be somehow between unexciting and lousy. So, although the mutual fund return is going to be unexciting and lousy for these active mutual funds, he is saying that you investors are going to get even below that median return. Why? Because of that cost. So he is giving a wiser choice. So the wiser choice is to dispense with the consultants and reduce the investment turnover by changing to index investment in equities. So he has clearly given his verdict that a wiser choice is always to changing to index investment in equities. And that's the way. And Charlie Munger, he is a partner of Warren Buffett. These two are the really I would say that they're the giants of investing world. And if they are giving such advice to real investor, then we should be definitely listening to them. Charlie Munger finally concludes saying that the simplicity has a way of improving performance by enabling us to better understand what we are doing. If we really understand what we are doing, then that way we can control our behavior. So, investor behavior is very important. And if you are not making your investment journey simpler, then your behavior can never become simple. And without simplicity or with complexity, your behavior can also become complex, and this can create some lot of havocs in your investment journey. So we should be avoiding them. So simplicity is the key to go. So I hope by now all of you understood how to make the profit from this majesty of simplicity and parsimony, and you will be convinced to hold these traditional low cost index fund to track the stock market. So thank you for staying with me. I hope you really like the content and you make get some value out of this thing. If you really think this kind of a contents are helpful, especially to the new retail investors, then feel free to like, share, and subscribe to as many people as you can and make them wiseful. Share this wisdom of investing with all of them and become and make sure that they become the intelligent investor. They can fulfill their financial goal and become successful in their investment journey. So I'll again meet with you in the next chapter very soon. Till then, thank you. Hare Krishna.